Greetings, viewers. Today, I'm attempting my valuation of Kansas City Southern, which is a railroad based out of United States, which has been a subject of a takeover battle between CN and CP, the two big Canadian railroad providers. So let's get started with the valuation. So for my valuation, I start with just looking briefly at where the KS stock is currently trading, which is at about $271. And you can see that it has had a significant run in just about less than a year or so, where it's jumped from around about 80 to 90 to about $271, which is about a threefold jump. A lot of it to do with the news around the acquisition. So for my valuation, I will take you through a few steps, which I'm going to be highlighting on the next slide. So I start with an analysis of just understanding what um, the um, the competitive environment or the competitive landscape is under which KSU operates. I look at some of the past trends in revenue growth as well as margins, and those are along with the guidance provided by management are built into the cash flows, which are projected out 10 years. Parallelly, I calculate the weighted average cost of capital as well as return on invested capital. Use them in the discounting numbers, the weighted average cost of capital, and bring the terminal value back to the present value to calculate and divide by the number of shares to calculate the per share price that uh, that the DCF model will generate or display. So let's get started by looking at the North American railroads. What you'll see here is that there are six publicly listed companies. The biggest operator is the BNSF Railway, which in terms of biggest in terms of number of miles, was taken over by Berkshire Hathaway. So if you just compare it by the number of miles of railroad network, Kansas City Southern is the smallest player of all the operators. But what makes it important in this analysis is that it is the only player that extends from United States into Mexico, giving it access to the ports in the Gulf of Mexico. Uh, so it is of it has a network that is truly pan continental, especially when it's merged with one of the entities that operates out of both US and Canada. Now, the other thing that I noticed about these numbers for that almost all of them, they are operating around a very small band. That the operating margins as a percentage of revenue are clustered around that 40% mark for all these companies. And it just seems like they are being managed to a formula. And you can see that in the net margin as well, where although CP does stand out, but the rest of the players all cluster around the 26% mark. So I thought this was a bit of interesting because it seems like the industry has certain benchmarks against which each of these are measured or at least measuring themselves. Now, if we look at how the revenue growth has been for the past few years, specifically for KSU, if you just look at the revenue growth, it's been shy of the 2.5 percentage mark on an annual basis. It hasn't been very strong. It has been very low, but it's just kind of average around that. We've seen a drop probably because of COVID and the trade volumes being low, but we've seen a rebound as well coming into Q2 of 2021. if we look at the margins, and that was kind of my observation with the earlier network, they seem to be the gross margin is seems to be steady around that, a little bit above the 80% mark. The operating margin a little bit between the 30 to 35%, and the net margin around the 20% mark. So they seem to be very strongly clustered uh, around certain numbers, or at least that's the observation I have. Now, KSU has been a subject of takeover. If you looked at, this is from the management presentation out of Q2, and if you looked at this slide out of Q1, the only difference is that CN has replaced CP in the Q2 presentation. But there is a probability that the Biden administration might not let the merger go through, in which case the stock, um, it might again be on the table for CP. So the brief history, CP had put in a $275 per share offer, which was counter-offered by CN, which is at $325 per share. So the real question is, is the acquirer getting a fair share for their buck, as in how much is the stock really worth? And to build my DCF, I've used or started with some guidance that was provided by the management. Although the revenue growth has been way shy of double digits, the management is projecting a double-digit growth in 2021, and a free cash flow of about 700 million and a capex of about 17% of revenues. I have used a higher growth number. I have used, let me just get to the assumptions quickly in terms of how I use these numbers. So for a company that's just grown at about 2.5% for the last decade, I have used the management's guidance to use a 2021 growth rate as 10%. It might come higher, but I think I'm compensated it by the fact that I'm assuming a 7.5% growth for over the next few years after the COVID bounce is done. And post that, year 6 onwards to year 10, the rate of growth converges towards the risk-free growth of the economy, which I'm assuming at around 1.3%. The operating margins I've kept at around 40%. They all seem to be clustered around that number, and I've just kept it at that number. Now, the other two parts about, I've used a reinvestment ratio of 0.4 for sales to capital to sales. And um, I must say that it is a company that is a creator of value. If you look at the return on capital, that is higher than their cost of capital, which happens to be about 7.2%. And what I'm assuming is over the next 10 years, that cost of capital comes down to, for a more mature company, of about 6.2%. With that, the projections are built out, the revenues, the operating margins after taxes, the reinvestment taken out. Now, this number is higher than the 700 million that the company is projecting, but I think I'm using a fairly higher growth number from what they have displayed recently, and that reinvestment would be needed to justify that growth going forward. So we put all this together and we come to the final slide, which is the valuation. So how does the number look like? I project the terminal value, bring it back to the present value. I am KCF has been a going concern. I don't think that there is, they have debt, but I don't think there is a cause of failure or distress because of debt. So I haven't assigned it a probability of failure. I've taken out the debt, added the cash back, and accounting for the equity options and dividing by the number of shares, I come up with a stock price of $149, just shy of $150. and the stock is currently trading at $271. So I think it's really interesting that the stock's at about 180% of what I estimate the fair value to be. And this could become important in case the merger does not go through. So I'll be watching the railroad space just because of the news on the merger, and if not, what happens to the share price, and if it presents an opportunity to get into this franchise, which does have a rate of return which is greater than the weighted average cost of capital. The price point would be the key point of interest. Also, I'll be looking at CP and CN in the coming weeks just to make sure that um, just to understand where these two companies are, either in combination with KSU or just by themselves based on where the merger goes. And if there is an interesting price point that opens up to add or um, initiate positions in both companies. So that's all for now. Thank you so much for watching. If you have any comments, please leave them below. And if you can hit the subscribe or the like buttons, I'll really appreciate it. Thank you so much, and bye for now.